Weekly update of the U.S. stock market. It is 7:48 a.m. Eastern Time. It's June 29th. I'm Rich Posson for Critical Point. Okay, so the market is winding down a quarter, a first half year, as well as a month, and it's also preparing for holiday as of next week. So there's end-of-month trade as well as people preparing how they're going to start next month as well. Not a lot of exciting economic news, but we've seen some interesting discussions that's looking bullish. One of those discussions is a variety of quantitative analysts and technical analysts are showing that when the stock market was down a prior year, as it was last year, and then it was up more 10% or more during the first half of the current year, and that's the case this time around, then 100% of the time the market was up 3, 6, 9, and 12 months later, and it was up as much as at least 5%, 10% to as much as 40%. It looks like we want to think in terms of averages of the upper 10% area moving into next year. The way it looks to me, it's suggesting there's potential of near term to 4,500 to maybe end of the year at 4,700, and does suggest chance for record high prices next year. Well, this dovetails with what we're doing and all of our analysis here at Critical Point, and it's suggesting that we can achieve record highs by next year. So there's a variety of other little smaller news, lesser important news, such as the money flow. There's plenty of cash on the sidelines that could come in to propel this stock market higher, and we just need a little better economy news. Once again, this week we saw news of people backing off on the idea of a recession. We've also seen discussion of people who are trying to scare us that the consumer is running out of money. Well, they're only looking at specific portions of the money that the consumer likely has, and it's looking as though there's other measurements suggesting the consumer is sitting on a mountain of money, and there's evidence they are out there spending, they are doing business, and they are working. Now, the Federal Reserve is also trying to scare us into buying stocks. They're scaring us, trying to scare us. They don't want us building businesses, starting businesses. They don't want us paying more for labor is the number one thing. And then they'd like to be able to see rentals decline, which is a difficult thing because I think it's basically a rigged system. It's bad capitalism. It's bad economics. The rental people have blown this whole free market thing way out of proportion. I mean, it's insane for a rental company to say, well, we're going to adjust the price on a daily basis, so if you're interested in our apartments, be sure to call us and see what's the latest price today for that apartment. That's asinine. That's all there is to it. We don't need to live that aggressive of a free market system. In addition, the rentals are very good at nickel and diming everybody to death even as they leave their apartment, and I've had personal experience of that in recent years, and it's a scam. It's a shame here what's going on in the rental markets in this country. And the political stuff doesn't seem to matter anymore to the model here, and probably won't till we get near the election time. At any rate, everything really, in my opinion, is bullish. It is optimistic. The economy is going to improve. Maybe the PMIs we'll get next week will still show some problems and complications, especially for manufacturing. But I think it's still just a matter of time. They're going to move up. They're all going to be above 50, suggesting a growing economy. And in my opinion, they're already well enough. We're on our way. But we need more evidence than this. That is a little drawback. But GDP has actually been performing better than the PMIs, and the two should correlate. We use PMIs as a shorter-term viewpoint of what's going on with GDP. And they split back in the virus pandemic, and especially last year with inflation. We need to get them back on board here. But it looks like to me the GDP is stable. There's some quality to it. It's up and away for the economy. So let's take a look at the intraday chart here briefly. What we think is this is a level 4 upswing. That's just intraday. Sometimes the swing can be just, sometimes it's intraday, but in general we think of it as intra-week, especially when combining an upswing and a downswing for level 4 for a business cycle. We think of it as intra-week. It's the pops and drops during a week. Anyway, we think yesterday was a level 4 top, level 4 bottom immediately, which is a sign that the market could be quite strong, that it's in a larger uptrend, and we think that's the case, which we'll explain in a moment. But for this level 4 swing, we do have potential in the futures to go to 44.78 to around 45.10. Now, the futures probably are maintaining a 20 or 30 point premium to the cash, so the cash would have a lower upside target than that. Overnight, the market's taking out that level 4 top. It's starting to give us some proof it wants to go higher. But now we have to see if the cash market at 9:30 a.m. Eastern time and later today will oblige us on this and actually follow through and move higher. Now, if the market were to trade below 4,400, okay, or down to 4,400 today, that could just be a trap and it snaps right back up the next day, but it would concern us a bit. And if it's below 4,400 by tomorrow, going into tomorrow, that would concern us more, that the market is stalling out here in this level 3 trend. Why is it? Is it just stalling out because of an end of month scenario? We're not so sure, okay? We'll have to reevaluate that if it occurs, but that's not the best forecast. The best forecast is the market ought to move higher. All right, so next we want to swing over here to our daily chart, and we'll start with the S&P 500 cash. And what we believe is this is a level 4 top, and we think it came into a level 4 bottom, but we don't have proof of that yet, especially off just this daytime daily chart. It's only the futures giving us a clue it ought to go up. But if it trades above 4390.35 today, I think we need to consider this market is going to work higher, okay? And we think this was a level 3 downtrend and it's in a level 3 uptrend, and I'll show that next in the futures market. Anyway, if we can get this going, there is a little gap just above the high of June 20th at 4400.15. It ought to push into that at least, but we think it's going higher still to 44.74 to 45.55 or something like that. Take out that high of the year. Okay, so next what we want to do is take a look at the S&P 500 futures for a little greater detail, and we have more model analysis on it. So what we're seeing is that the market put in a level 3 top, it declined to level 3 bottom, and seasonally last week the market on average for decades declined that week, and it did it again, okay? Well, seasonally it's supposed to be up this week, and it's doing it. It's not up as robust, okay, but they're taking back what they did. They sold some last week and they're buying it back. I don't think they really sold as much as the prices and charts reflect or show us, okay? I think some people bought a lot 2 weeks ago and they're setting on some of that and they wrote it down. But I think they lightened up a little, and then I think it was really more the very extreme short-term seller was betting on the downside, but the more important, say, long-term, intermediate, short-term demand backed away, and it just made the market vulnerable to a little bit of selling, and they put it down, all right? I think this was just a correction, a hesitation, a larger uptrend. So now I think to go back to buying, and what they should do is buy this into next week. Now, in theory, the market could top tomorrow. If it bounces into tomorrow, but next week spends several days of sideways to down, we will say, gosh, it topped as of this week. But the best forecast is saying, no, it'll probably extend into next week, and it could even extend to late next week because of a distortion of the holiday next week. Could take it a little bit longer than normal. But looking out to next week, to the following week, yes, it can set back for level 3, but here's what we think is going to occur. The number one forecast is it moves up into a level 3 top, then it actually moves up through the level 3 bottom, but at a slower pace perhaps. And that could be a sign of a running correction, meaning a very strong market, that there's a portion of the market participants trying to drive it down for that level 3, but they can't get the job done, that many of the other traders, investors are buying, and they're countering, okay? And then when it comes through that slow phase and that level 3 bottom's in place, the market will actually speed higher, or likely, I should say, okay, and speed higher into the next level 3 top. Basically what we're saying then under that scenario, and that is our number one highest probability, highest confidence scenario, is the market's not going to pay any attention to this level 3. It's going to now rally into probably late July. All right. Now the second forecast is the market will actually move sideways. And we have an example of this. This is 2 level 3s combined, and here's one, and then it moved sideways, and then it moved up. And notice it moved up at even a faster pace after that sideways move. That was a type of running correction, okay? It was a sign of a strong market. Well, we're thinking the same thing can occur here. And there are a monthly type of trader who really can trade a month and a half. And what they're really doing is combining 2 level 3s. And we call them L3B traders. They're a smaller group. It's in the model. We don't talk about it much. But we've noticed in recent years, it seems to be a little more popular trade with people. And people have recognized that. They're picking up on it. They don't treat it the way we do. They don't call it what we call it. But they're picking up on it, and they're actually helping to cause that. So we think those are the 2 best forecasts. Now, the least favorite forecast, lowest probability, lowest confidence, but not by a huge amount, is that it'll actually come down and maybe a sizable amount in that level 3, looking out into next week, the following week, but it still should go higher later, is still our best forecast. So we now think the market is above the 5-day average, is turning higher. We have the daily stochastic spreading, widening its spread as it heads for overbought. That's a warning we can have lingering near-term upside momentum next 1 to 3 days. Well, guess what? That's what the model's saying, okay? And it could even stay up a little longer than that. All right, so that covers our short term. Now what we want to do is move over to the weekly chart, and we'll start again with the S&P 500 cash. And what we're saying is, as we discuss the level 3 trends that are the largest up and down move during a month, it works for all the liquid, well-known markets. It's how we do business. We just can't help ourselves, okay? And it can be the largest move, but also the longest duration amount of time, even though they can be as short term as a couple of days. So the next trend is a level 2 or L2 trend, and it can last as much as 3 months. It can be as little as 1 or 2 weeks. So it can act kind of monthly like a level 3 at times, all right? And it's kind of how we do business quarterly. And then 2 of those level 2s will combine for level 1, but sometimes they'll actually combine 3, which makes it a bit tricky on us. And sometimes that is, or more likely is, due to some surprising news kind of stretching things out a bit. The level 1 at times can just be a 1 or 2 month deal, a little more like a quarterly deal. And quite often we will not see a level 2 within that trend as a correction of that trend. Other times it can be 4, 5, 6, 7 months, okay, for that level 1 trend. And when it's that long, we always see a level 2 causing a setback within that trend, a correction, all right? And this is a fine example of it. Level 1 bottom in March. The market was to be up into this week, ideally into next week, and on into late July maybe, okay? But along the way, a level 2 was to occur, and there it was. And notice this is the default worries over the U.S. debt. And all it caused was basically sideways price action. The market was concerned. They knew they bet a little on the downside. They had to, respect it somewhat, but they really didn't want to. They were very convinced, we'll fix it. We're not going to go into default. So they were just trying to set still the best they could. But some of those maybe very short-term traders were causing some emotion in there and some volatility. But also notice since October 12th, which is not only a level 1 bottom, but also a minor long-term bottom, an end of a bear market of last year. And when that occurs, there has to be a level 1. Level 1s are always required for any kind of long-term turning point, okay? And so this is a new bull market into next year. We'll explain that in a moment. But notice the downsides of level 2, level 1, level 2, they really weren't that dramatic. They didn't take the market all the way back to the October 12 low, and the reason is it's in a bull market. But if you label all the news that occurred during these downside, some of that news was even more bearish than what there was last year. and the market didn't go down. The market is doing its best of saying it's over and done with worrying about the future. It doesn't see the bearish information causing long-term problems. It's only going to cause short-term problems, hesitations, moments to reflect and reevaluate, and then later just decide, you know what, life goes on, business is going on. They're even rejecting the Fed. Yesterday, Powell was out again saying, yep, we're going to have to raise rates more. That's all there is to it. He's trying to beat up things. He wants more time to get those inflation numbers down more. And we don't need them. They're turning insane. The Federal Reserve is just messing with us, okay? But I don't think the Fed will raise rates high enough, long enough to actually kill the economy. I think these perma bears, mega bears, the bubblenistas, which believe in bubbles, but they want them to burst, they're predicting them to burst, okay? They don't understand these major long-term bull markets. They don't understand their own track records that they've been wrong basically forever. If they're looking for gigantic down moves, imploding economy and destruction, they've always been wrong for the history of this country during the major bull market growth phase for the economy and for the bull market for the stock market, okay? Now, when I say they've always been wrong, if they were forecasting drops of 20 to 35% and it occurred, and then they decided it could go back up, then they were actually right, but they were kind of like over-exaggerating everything. They were really somewhat in line with what the business cycle would do. The business cycle does allow as much as 35% drop during a bull market, during a growth phase, okay? But it's rare to drop more than 20%, and last year the market dropped 25%, so it was a rare occurrence, extreme. We overdid it. We made the market too cheap, held it down too long. We made it too big a deal. And you know something? By October 12th of last year, in my opinion, there was less selling than there was in June, even though on October 12th the price was lower still. People were already giving up on the downside, all right? So where are we today then? We ought to have a move up still. Now granted, the market could top this week according to what we show in the futures and even for cash, but we're not showing it with cash. We're showing our best guess is it could top for level 2 and level 1s, and it will have to coincide with a level 3. And the best forecast is level 3 tops next week, so that's why we think it's next week, not this week. Now the interesting thing though is it could pull back out of a level 3, maybe even scare us a bit that, hey, it's top for the more important tops, level 2, level 1s, only change its mind, bottom for level 3, and rally to a new high for the year for the next level 3 later in July, mid to late July. And that would just be the next opportunity. Whether we like it or not, we'll have to throw a dart to find the next level 2, level 1 top. But what we're doing is being a bit brave, saying these level 2, level 1 uptrends are going to last longer than they did last year. They're going to be more like 2021 to 2020. They're going to go up more, okay? It's going to be easier to pound out new highs for the year. It's going to be less downside and a lesser amount of time downside. We think indicators on the technical and charting side are going to have more false signals and just stay more overbought longer. And that's the characteristics of good bull markets. And we think we're in a good bull market. So anyways, the best forecast is even though it's pulled back to our original price target, it overshot it a bit and we got 2 gold stars instead of 1. It's pulling back, trying to respect it, saying maybe we actually got it right after all. But frankly, we think it should go higher on this and maybe go on up into this range on up to about 44.70. And we think it ought to take out the high at 44.48.47 next month, all right? And we think it may trade up to 44.70. Now, it's possible it could do so well and stay up right into the end of July, it might make it to 45.50, but we don't know how much to bet on that. We'd love to see it. We're greedy. We're hungry for this. Let's go. Let's have some fun. Let's make some money. And it may do it. But it's also possible 45.50 and higher will wait until September. We don't think it will be any later than September. and they'll be still higher by the end of the year, and we'll explain that in a moment. Okay, so we think this is nothing more than a setback. They bought a huge amount, got aggressive, they did not need to buy any more, and just a few little fools played the downside, and they brought down a multi-trillion-dollar market, even though there was very little selling. It was just because the demand backed off enough that it was feasible to do it. Okay, so now what we want to do is switch over to the futures. And the S&P 500 futures, and by the way, I know I spend 99% of the time talking just the S&P 500. Dow Jones and NASDAQ follow these similar patterns, but sometimes they can be 2 to 3 weeks of different timing, okay, a little later or a little ahead of the S&P 500. But in general, they're doing the same thing. And the NASDAQ is the stronger, by the way, and it may be the stronger this year, even next year, off of this AI boom. That may be a way to make a little more money in the NASDAQ and the S&P 500. And it normally has over the past 10 or 20 years. It's your newest, your hottest stocks, but there's also more downside risk, so consider that. At any rate, the S&P 500 futures also kindly came back into the upper side of our target range. I didn't need it. I wished I hadn't. I wish it'd stay strong, just keep marching higher. But I think, again, just a setback, a correction. It came near the 5-week average. It's trying to turn up now. We think it's just level 3 fluctuation. We think it's going higher into that level 2, level 1 top sometime in July. And it may take all the way to the end of July, even the first couple of days of August, but we'll target July. All right. Now, we also think for the futures, it can go to 45.65. That would probably mean lesser than a 45.50 in the cash right now. We think it could go maybe to 46.34 eventually, but we don't know how long these upper side targets will take. All right. But first, we do have to consider that when we find that level 2, level 1 top, the market should pull back for 1, 2, 3 weeks. It might even stall out for 4 weeks. Okay. We think what it should do is pull back into a bottom sometime the week of July 17th to the week of August 14th. This is giving us an idea how long it will take them to sell enough to where they decide they want to return to buying. But it's also a warning on the fundamental news side how long we might get some negative news. It's also a warning how important that negative news. There could be something shockingly negative or bearish late July, early August. We don't think it's really going to work that way, but we can't rule it out. We got to be looking over our shoulders. But ultimately, we think this is going to be a modest setback, stalling out, and then it's just going to move higher into a level 2 top in September. Now, seasonally, over the past 150 years, September and October, most of the time, on average at least, has been some of the worst months of the year for the stock market. Okay. However, this time around, we don't think it's going to work that way. We think it's going to be just a slight decline. It may be 1 or 2 weeks of some real volatility and scariness, and then it's just going to pop back. But if it's going to take longer than that, we don't think it's really going to do much of anything. All right. Now, once it's put that level 2 top in, it'll put in a level 2 bottom right about that September-October time frame. And it should be back up for another level 2 and the next level 1 top in November, December. November, December over the past 150 years has been the strongest, better bullish years. At the moment, we don't know how bullish to expect. We can see that it kind of coasts in the end of the year. But by the end of the year, things could be quite bullish. It's possible to even have a record high price. We doubt it, but we're targeting 4,600 to 4,700s on the S&P, and here we are at 43.45 in the cash at this time, I believe. Let me double check that. As of today, 43.32, 44.32 actually. All right, so that's where we're at. All right, so again, yes, we know there's some downside coming, but it looks like the best forecast is additional upside coming near term, then the downside, and then we're going to continue to zigzag throughout the year. We don't think it goes much lower than what we've seen here in the 4300s. We think downside is rather limited. All right, so now what I'm going to do is, first of all, now that I'm on my list of weekly charts, let's go to the percent stocks of the S&P 500 that are above their 200-day moving average. Even the fundamental people, for many decades, fought technical people. They thought they were kooks, that they didn't know what they were doing, and now they've learned to respect. In fact, most of the actual buy-sell signals, entries, exits, and some of the risk management is technical these days. Most of the market is technical. The fundamentals these days only provide guidelines for these investors and traders, especially the more active, aggressive ones. It provides guidelines to be bullish, bearish, general ideas of what something's worth, and that's it. Hardly anybody is buying and selling off fundamental news and information anymore. That's how bizarre this is. It's turning into more and more math and price-oriented, all right? Any rate, the 200-day average is even watched by fundamental traders as a sign of being bullish. If it's trending up, they assume it ought to be bullish. If the market's above it, it ought to be bullish. And they do this even on individual stocks. Anyway, we could see they bought 2 weeks ago aggressively, sold last week aggressively. They've already bought it back this week, and the week's not even over. This was a hiccup. This was a fluke, fake out, just causing problems for us bulls. It should move higher during the year. I don't know how high it's going to go, but I think before year end, we'll be up to about 75% of the stocks above the 200-day average. Why is this important? Well, it's a clue of breadth. What's breadth? Well, it's the number of advancing stocks divided by the declining stocks, and some even subtract them and give you an actual number, some of them like a ratio, and then they usually smooth that out. And what it tells them is, are investors interested in pumping money in a greater number of types of stocks, not just more of a specific stock, okay? And so that's usually a good sign that they are detecting a greater number of businesses making money and will make money. They're forecasting that way. That also normally is a clue probably the economy is growing and will grow. They were forecast that way. So it makes them bullish and more bullish. All right, and we're hearing some good stories of breadth. I've seen a different type of smooth study of it that it's actually stronger than the stock market. That's almost back to record highs, if not punching out record highs. So it's suggesting the money is flowing into the market. It's a bull market, all right? People are putting in the money. The weird thing is people might be saying they're still bearish, yet they're actually buying stocks. They might be saying they're not bearish, but they're not all that optimistic and bullish. They're still a bit nervous. But then you look what they're doing, and they're going headlong. They're just diving right in and buying a bunch of stocks. And that's what I love with this kind of modeling business cycle. It helps us with this complicational problem that people can do, say one thing, they can do something else, and they can even think something else. Or you get 2 out of 3, and then occasionally all 3, okay? And that's actually has evolved from, say, 100 years ago when they only said one thing and did something the same or other. And now we got this more complicated thing of saying one thing, maybe thinking something different, and actually doing one of those two, okay? Or maybe even something different if they're in complex strategies. All right, here's our monthly chart and minor long-term business cycle bottom that occurs every 3 to 4 years. So basically the market's up 1 year, the next year it's up some, then starts coming down. The following year it's down, but maybe bottoms, or it spills over to next year, turns around again. That's a minor long-term business cycle, 3 to 4 years. On the economy side, it's called the kitchen, and it actually relates to business inventory is what it was discovered in, but we've learned you can find in all kinds of business statistics, economic statistics, even how people think and behave, okay? And we find it in the market, all right? It's a little miniature boom bust, but long-term type cycle. Really what it is, it's throttling up, throttling down. When you're in the growth phase and the economy is going to grow for a decade and the stock market's going to go up for a decade, that little kitchen cycle, or in the stock market, this LT3, creates the largest up-down moves and longest moves, zigzagging on the way up during the decade. Then it may create zigzags on the way down for the recession and once a decade bear market, or that bear market recession can be so brief that it's simply just down once, that's it, right in line with that larger decade cycle. The larger decade cycle is called the juggler business cycle, discovered decades ago. It still works. It's how the economy operates. The economy grows about 7 to 12 years, and then we have a recession for about 1 to 3 years. The stock market correlates better than ever with that. So we have a bull market 7 to 12 years, a bear market 1 to 3 years. This LT3 is creating almost like bear markets every other year, bull markets in between, but those bear markets don't do that much, and it has an overall bullish bias for 7 to 12 years. That's how the market really works, and it's amazing to me intelligent people miss out on that. They become too bearish during the growth phase. And some of them give up by the time of that juggler business cycle recession bear market, and they miss it. They have to catch up yet again. All right, at any rate, this is our forecast up, down by August, up again, and these are level ones. We probably will not adjust it that much for the duration of time and the actual timing of when it will occur, time-wise, not price-wise. We may, and this is also a price forecast, but we'll probably adjust this more than we are on the time and duration. We can get this wrong, okay, and have to make sizable adjustments at time. All right, we're less concerned of that. But notice what we're forecasting. Bullish into next year. Bullish to record highs. This is all intact. It's all working for us, and we don't want to let up on it. We've got to stay focused now. And let me go back to that. Here's some things you can do with this. If you're a long-term bull for the rest of this decade, it's quite possible you just use this for information. That when it's down for a month or two, you didn't do anything about it, but you knew it was coming because the model said so. And you wrote it out, and it makes you feel more comfortable to keep writing it out until we get to something more important and you decide to sell it. Okay? Like I can tell you, I'm dumping everything I own at the end of the decade. Okay? I'm probably going to be more aggressive in 2025 and dump more than I did in 2022 because I'm upset with myself that I didn't follow my own model and take it a little more serious. I did follow the model. I think the model did fantastic, frankly, last year. I should have sold a little bit more. I should have been more patient and bought back in a little lower price. You can do those things too, jumping in and out for some of your portfolio and take some profits, reinvest the profits so you own even more, so you make even more during the next upswing. Now, the next thing you have to consider is if you don't want to trade that way, some of these pullbacks along the way might be opportunities to invest more if you raised cash. But I fully understand if you automatically put money in weekly, bi-weekly, monthly, you might say, so what? Just keep putting it in. Don't try to pull that money together and then throw it in on one of these level 1, level 2 bottoms, okay? I fully understand you might not want to mess with it, all right? But if you do like doing things like this, hopefully this type of analysis will help you make better purchases along the way during this bull market. So frankly, I think even the short-term trader who's going to jump in and out many times this year and will bet on the downside even if I say that I wouldn't do it, that they at least ought to keep in mind this long-term background suggests you ought to bet more on the upside than the downside. You better manage that risk of not fighting this bull market because a lot of money's been lost by these so-called smart guys over in some of these funds here. They've been wrong here for a while. All right, now what we want to do is go to the VIX. And on the VIX, what we want to say is here's that minor long-term bull bear market. Now in the VIX, it's opposite of the stock market. If the VIX is going down, the stock market's going up. If the VIX is going up, the stock market's going down. We've been forecasting the VIX is down into August to probably late next year. Even if it bottoms soon, we don't think it goes up much at all until after the top, maybe late next year. And it may not even occur to early 2025 if they like the election and if the economy is hanging in there, okay? So this is just a general guideline, but we're pleased at how well this is working. Now, the VIX is very low, so some people getting nervous we're going to get some spikes, but what we're saying, they're not going to be huge spikes. We're not going to get gigantic pullbacks in the stock market now well into next year. Maybe in 2025, a little more downside. Right at the moment, I don't think it's going to be as severe as last year, but it could be. I think it'll be less, but I'm still going to try to play it a little bit differently than what I did last year. At any rate, that's the trend. We're sticking with it. It seems to be working with us. And what it's reflecting is that people don't want to bet on the downside. And they don't even want to buy insurance for their stocks. They don't want to spend the money. They are bullish. They're being optimistic. They want a brighter future, and they think it's coming. They think even if we were still in a bear market, fundamentally, that the stock market price-wise is not. It's changed its mind, okay? There's not enough selling to drive it down. They think longer term, they see the possibility of doing away with whatever bearish lingering information is there, and I think they're going to be right. How about outside markets that may or may not impact our forecast here? Here's the dollar. It is due for bottom. Maybe it's bottom. Maybe it's going up in July, down in August. It may go down for another couple weeks, however, and then up. We don't particularly care. We don't think it's going to move up by huge amounts that might hurt the stock market. We think overall the dollar is bullish for the stock market, and we like this level of the dollar. Would appreciate a little lower, but we like it that it's actually positive for the global and U.S. economies, okay, and the stock market. All right. Gold, we think it's in a bear market into next year, maybe the following year, but it can give us a lot of problems along the way. And it is down into the time frame for level 1 bottom. It may yet bounce into summer. Maybe it goes higher than we think. We don't think so. And really, we don't think it has much to do with the stock market. Bitcoin, we think it has nothing to do with the stock market. It either follows the stock market or it does its own thing. And it is due for a top soon, okay, very soon. And that may coincide with a top in July for the stock market and set back some. Longer term, we're bullish, but we don't know how bullish to be. We understand some people are just barely bullish. They think it's only going to pick its head up, and that's about it. All right, crude oil, we don't think it's really going to have much to do this time around with the stock market. We like the price level that's bullish for our economy. We don't think it can jump by huge amounts to hurt the economy or the stock market. So we're not going to be concerned if it does rally here this summer. But we think it's pretty much stuck in the doldrums, not going to do much. And we're not particularly, it is due to bounce, by the way, but we just don't think it's going to cause complications and problems for the stock market. Now, here's our interest rates, and yes, we are bearish interest rates into late 2024 to 2025, but we are concerned they may not go down much at all for a long time because the Federal Reserve's probably going to be stubborn, probably going to be a nuisance, a pain in our side. They just won't lower the rates for a long time and may yet raise a bit more. So, however, the free market is ready to go lower, but it doesn't know what to do about the Fed. So it could probably is limited to how much lower it can go. We think it's put in a short-term top already. We think it's going lower in the next week or two, may even go lower over the next month, but it might be rather limited. We're viewing it like the other outside markets. If the interest rates don't jump by a huge amount, we don't care. Okay, the stock market's still going to be bullish. All right, now we could be wrong on these interest rates that maybe in a couple weeks it places a level 2 bottom and may be higher still in July and August, may go to a new high for the year. We may see a rebound to 4%, and a lot of people, not a lot of people, some people are starting to forecast that now. That may give us some problems, but we don't think so. And even if it does, we don't think that's high enough to cause a problem long term over the next couple of years for the stock market. But I just got to warn you, something could push this higher, and it probably would be the Fed. But we think the bond market is trying its best to fight the Fed, and that's the correct thing to do. We don't want the Fed to scare us out of our stocks. It's time to be bullish the economy, the stock market, the U.S., and make some money to the upside, okay? So I will finish here just with a reminder of what we're working on this weekly chart. I'll go to the cash market here, and we just believe this market is up and away into mid to late July, and it is going to go to a new high for the year. We fully understand how it could stall out or even top out sooner. And we fully understand later in July and early August, we have to look out for a setback. But we firmly believe it will be contained, restrained, and it will be higher still by September. And we believe this market's going higher into the end of the year. We've got new highs coming for the year. We believe this market's already worth 4,500 to 4,600. It's just a matter of how soon can we get there. And when we get there, if it's before the end of the year, can the market add a bit more? Past results are not necessarily indicative of future results. Have a great week and weekend. Thank you.